even among the boomers, 78 million people. I mean, they're heading into what? Their 70s. 60% of their asset mix is in equities. It should be half that.
Right.
So everybody is all in. Nobody has rebalanced. Nobody has diversified. And when this turns into a bear market, if you believe in cycle theory, the impact this is going to have on the economy by a reversal in the savings rate would give you a very significant consumer recession.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. 2023 was the year of the recession that wasn't. Now, 2024 is looking to be the year of the hard landing that wasn't. So, how is 2025 shaping up to look like? For guidance, we turn to highly respected economist and award-winning researcher David Rosenberg, founder and president of Rosenberg Research. David, thanks so much for joining us today.
Well, thanks for having me back on, Adam.
David, it is always a pleasure. Lots of questions for you from a lot of your recent activity that I want to dive into. But I guess real quick before we do, let's just start the way we always do with this intentionally general question. What's your current assessment of the global economy and financial markets?
Well, the global economy to start off is not a homogeneous entity. So depends which part of the world you're talking about. The U.S. economy is miraculously hanging in well. You go north of the border in Canada, and there is continuous erosion in real GDP per capita. So immigration and population growth has masked what is truly a recession in the 51st state. You go to Europe, and it looks like Germany is heading back into recession with obvious implications for the entire continent. And then you go to Asia, and Japan looks flat to slightly positive. And let's face it, if Chinese demand wasn't imploding, you wouldn't have the Chinese authorities massively trying to undertake stimulus over the course of the past couple of weeks. So it's really a mixed bag, but I would characterize the global economy at best as muddling through. It certainly is not the consensus view of some economic boom taking place right now. Not even in the United States. Hanging in is different than booming. As far as the financial markets are concerned, I think that you have a situation where in the United States, with a 21-22 forward multiple on the S&P 500, it is more than fully valued. The equity risk premium is ridiculously thin. The markets continue to make or approach new highs, but it's just too expensive for my liking. And there's other opportunities across the world. We like Hong Kong. We like the UK. Canada, actually, despite its economic woes, its stock market is screening better than the United States. There's just a deeper value in many other parts of the global stock market. And actually, in addition to Japan, emerging Asia is screening right now as our favorite region. And of course, because the valuations are trading at such a steep discount. Interest rates, the Fed cut 50. I don't think it was a mistake. They're going to go 25 at the next meeting on November 7th. I think we'll get a steady diet of 25 basis point increases. I think that those people...
You mean cuts, right? Not increases?
Sorry, cuts. I think those people that are saying that the Fed made a mistake and that they're going to pause, I don't believe that for a second. I think that Friday's employment number was a huge head fake. We can get into that. The economy in the United States, as you said, is not in recession, but you don't need recession to have interest rates come down. So I think my highest conviction trade is lower interest rates, a renewed steepening of the yield curve. Bond yields will come down, won't be a straight line. And I think that along with gold and emerging market equities, some segments of the stock market that I do like, I think that long dated treasuries is back up in yields over the course of the past couple of weeks. I think has represented a very attractive reentry point.
Okay. Thank you. We're done with the interview. You gave me everything I was looking for the whole interview. That one answer. All right, but lots to dig into to get to specifics. So literally, David, I want to hit on almost every point that you mentioned there. If we can, let's start that journey with this question. As I said in the intro, kind of the whole world expected a recession in 2023. Didn't happen. A lot of people still thought that shoes might be dropping throughout 2024. I certainly talked with many people here about, the lag effect and the impact that that may have on the economy from these higher for longer interest rates. But we didn't get the recession in 2024. There's a lot of people saying, hey, looking at the headline numbers, it looks like no landing, is the dominant outcome here. Why didn't a recession arrive when so many had such high confidence it was going to happen? And I'll let you answer it any way you like, but if you could address liquidity in there, because part of what I've sort of have taken from my perch is there was just so much shoved in, not only the pig and the python of all the stuff that was thrown in during COVID, but the continued like fiscal spending and whatnot that's gone through, perhaps maybe just shifted the timeline dramatically outside of the window everybody was expecting it.
Mhm. Well, I would tend to agree with that. We have to keep in mind that the typical lag from the first Fed rate hike to the recession is 30 months. So that puts us just about where we are right now. And in real time, you would argue that we're not in recession today. And the lags this time around have been longer than the norms of the past. But I'll take you back to that period when I was at Mother Merrill, when the Fed's first rate hike was in June of 2004, and the recession began in December 2007. So you and I would be having this conversation, say in the spring of 2007, you'd be asking the same question: where's this recession already? And
Mm-hmm.
of course, everybody back then, except for me, threw in the towel. The you go back to another cycle, for example. I'm not sure many of your viewers were around in the late '80s, but the Fed first started tightening policy after the stock market crash of October '87. The Fed started raising rates in the spring of 1988. The recession didn't start until July 1990.
Mm-hmm.
And throughout 1989, same question you would have been posing to me back then, which is, where's this recession already? So, yeah, it's taking time. I think that there's a few things that have happened. The relentless fiscal stimulus has been one. The fact that we had the stimulus checks that were mailed out. I mean, $2 trillion of stimulus checks in the winter of 2001 didn't get spent all at once, but that was a gift that kept on giving. And then once the excess savings subsided, the personal savings rate continued to come down. In other words, the household sector right now is putting 5 pennies in the piggy bank for every after-tax dollar they earn. That's half the historical norm. So it's happened that the savings rate has come down in support of consumer spending. As people throw more caution to the wind, they're spending more of their income and saving less of it. And a good part of that is because of the equity wealth effect. I mean, we have the S&P 500 up more than 30%. And people seem to think that it's a God-given right that the stock market goes up over 20% every year. So when you have this mentality that your 401k plan is going to look after you, you don't feel you have to save out of current income. And that's had a powerful impact on consumer spending. So it's really been a two-pronged economy. It's been the consumer, driven by the wealth effect on spending, and it's been the government in terms of the relentless stimulus. But are you really going to sit here and tell me that the industrial sector is not in recession? It surely is. The commercial construction industry, that's in perennial recession. And the housing industry is flat on its back. So you have wide swaths of the economy that are actually either stagnating or contracting outright. But the reality is that when almost 70% of the economy is consumer and they're being propelled by the equity wealth effect and the feel good factor from that, that I can spend 95% of my after tax income on goods and services, well, that gives you a lift to the economy. And that's really what the story is. And I guess you'd say, well, is that sustainable? And all I can say is that it's never proven to have been sustainable in the past, but it sure has lasted a long time. There's something else that we have to consider, which is that shielded borrowers from this pernicious interest rate cycle, going up more than 500 basis points on the funds rate, which is that at or near the generation lows in interest rates, a lot of people locked in,
Right.
corporates, households. But that gives you a delay, right? That is not a get out of jail free card. That helps prolong things, but you're gonna have to pay the piper sooner or later. That debt is going to renew and roll over. And the gap between spot interest rates and the normalized level in the past 5 years is call it between 200 and 300 basis points, whether you're looking at mortgages or autos, other forms of personal loans, or corporate interest rates. So all those people that say higher for longer, the Fed shouldn't cut rates, should be very careful what they wish for, because we will have at some point a debt servicing cycle that is going to impair the economy. It hasn't happened yet, admittedly, but to say because it hasn't happened yet, therefore it's not going to happen, takes me back to where we were back through most of 2007. And I want to remind everybody that the recession began in December 2007, and the widespread consensus right into the summer of 2008 was that we were in a no landing, as you call it. And the consensus was no landing, no landing right up until the summer of 08. And most economists on Wall Street, my competitors, didn't begin a call for recession until Lehman collapsed in September. And then the NBER, the official arbiter of the business cycle, tells us in December of 08 that the recession began in December of 07. And that caught a lot of people by surprise. But that's when the recession was dated. And what the NBER waits for is for all the revisions to come in. Now, I know that we had this upward revision to GDP and GDI. It's in the rearview mirror. But the next set of revisions will be to the downside, because we already know from the QCW that we had an 818,000 decline in non-farm payrolls from the what was originally estimated. Those numbers will come out early next year for the year through to March. I'm taking a look at non-farm payrolls, and 75% of the time in the past year, the revisions have been to the downside. I think a lot of people are putting stock in data that have very low response rates and very high sampling error terms. And I was astounded that the market leapt all over that non-farm payroll report that came out on Friday with a response rate of around 40%. It's 20 percentage points lower than it was pre-COVID. And there was all sorts of seasonal maladjustment with that number. We'll wait to see what October looks like. But it'll be interesting to see what happens once all these data get revised. That's what the NBER waits for. All the data that markets are trading off of that have this belief in a no landing, as you had mentioned earlier, are based on data that have unprecedentedly high sampling errors. But it's the only data that we have on hand. But I'll take you back to the beginning of the year, okay, when Philadelphia Fed President Patrick Harker said that because of all the revisions to the data, and they know about the low response rates, that the Fed was going to spend more time focusing on anecdotal and survey data. Survey data. I mean, think of the giant anomaly that in September, we would have had the combined manufacturing and service sector PMI job indices at 46. Below 50 is contractionary. 46 was the time, what was the second weakest number we had since the spring of 2020. And here we have a supposed jobs boom and non-farm payrolls. Okay. It's interesting that Jay Powell a few times at the podium this year has mentioned the Fed Beige Book, which is all qualitative, but it provides the most comprehensive assessment of the US economy by region and by industry, and it comes out every 6 weeks. The Fed has been releasing it since 1970. It used to be called the Teal Book, then it was called the Tan Book, now it's the Beige Book. So it gives you a nice, colorful display of what's happening, broadly speaking, in the US economy. And I've got news for you because we have the capacity now to do a lot of data science on a lot of things. I've invested a lot in AI. And when we look at the overall tone of the Beige Book that most recently came out, over half the United States is in recession or is in stagnation. Now, the one thing I'll tell you about the Beige Book, unlike all the data that people trade off of, is this. The Beige Book doesn't get revised, but the economic data gets revised. And that's why people were absolutely shocked that the NBR had the temerity to date the recession to December 07. But that was after the revisions came in. So we'll see how this thing cooks in the next several months and quarters.
Okay. I got a lot of specific questions, but just very high level. There are some analysts out there, and I'll pick one. I haven't interviewed him for a while, but this is my sense of his take on things. A guy like Ed Yardeni, who's said, the economy's kind of been in this rolling recession where it's kind of been handing the baton from industry to industry, and therefore we didn't really have the whole economy going down at once. And now we're kind of getting near the end of that, and all the major world economies are back to easing, and that's going to spur growth going forward. And we've made it. We've dodged the bullet. We're now in no landing. We stuck the no landing, and now we're off to the races again. I think I hear from you. No, there's a lot of just sort of fundamental issues in the economy, plus just the math of the lag effects and some of these things that have been put in motion that will ultimately arrive and continue to pull down the rest of the economy that's not in recession. You're saying from a lot of the data you look at, it's about half the economy probably still is in recession right now. So it seems to me that you feel like it is way too early to deliver a mission accomplished message, and that indeed, all things being equal, you think the risks are to the downside, not the upside, let's say over the next 6 to 9 months.
Yeah, I think that the risks are to the downside. I would say that I'd put it a little differently. I'm not a big fan of these labels. I mean, soft landing and no landing. Somebody invented the term no landing, but no landing is the same as a soft landing. So it's just that people like to invent words. I think that I find that there's a couple of things that are very interesting happening with the US economy right now, but it's mostly on the supply side. The demand side is what recessions are about. GDP is about spending, spending is demand. But I find it very interesting that we've had, since the peak of inflation, real GDP growth has averaged 3%. We have roughly 4% unemployment rate. So you can call that roughly full employment. And yet inflation's come down from 9% to 2.5%. How's that possible? How's that possible?
Right. Well, some would say repairing of supply chains for that element of it,
Yeah,
but
the
I get
supply
your point.
chains got repaired. Well, supply chains got repaired quite a while ago. This has been ongoing downward momentum in inflation that supersedes supply chains, which have basically the improvements already taken place. We are seeing two other things that are really more important for the US economy than global supply chains. One is that we have labor force expansion, that all the people that were talking about the great retirement theme, all the inflationists, it's very interesting is what happened to the great retirement theme. I guess it got retired. What happened to the fact that the labor force was depleted? The available pool of labor in the United States as of September was up 6% over the past year.
Mm-hmm.
And
And
what's
quips are
interesting is that
down, like
in
the
productivity is pressing against 3%. I'm really
Mhm.
amazed. I mean, at how the productivity has been an incredible story. But the aggregate supply curve is running at a 9% annual rate. But demand is running, call it 2.5 to 3. Atlanta Fed's at 2.5 right now. So we're driving this wedge between aggregate demand and aggregate supply that is very disinflationary. So frankly, I don't even need to have a recession call. And let's just call it for what it is: recession, expansion. These other terms are just ridiculous Wall Street
yeah.
colloquialisms. Um, and we had back in the mid '80s, we had coming off a Fed tightening cycle. We didn't have a recession, and interest rates just kept coming down for about 4 or 5 years. And it shocked everybody. And in the mid '90s, after the 1994, early '95 tightening cycle, no recession, interest rates kept on falling, and inflation kept on falling. And so I can understand that if we don't have a recession, it's important for the stock market because you don't have bear markets normally um, without a recession. However, to be bullish on the bond market, which I am, and notwithstanding the fact we backed up to 4% of the 10-year in the past couple of weeks, uh, that hasn't really unnerved me at all. It just causes me to be that much more interested in the bond market because I
Right.
think we're at
Better values. Yeah.
I think we're at a great reentry level. Uh, you don't need that recession call to be bullish on interest rates. But all that said, yes, I would say that the complacency over the economy is rather palpable. I'd have to say the risks I think are a lot higher. I don't think because everything got clogged up, and we'll see who wins the election on the 5th. We'll see if it's split government or not. Split government is going to mean gridlock, and there's a very high chance that no matter who wins, most likely we're going to have split government. Probably the Senate reverts to the Republicans
Republicans.
and the
Yeah.
House, but I think that's how the math is playing out right now. But really, who knows? But gridlock will be good for my call. I think there'll be a lot of problems with both parties' uh, economic plans, big problems. Um, yeah, you have Trump, who is great in terms of deregulation and great in terms of corporate tax cuts, which would lead to capital formation, business investment. However, his tariffs would lead to probably an immediate recession because it'd be a massive price shock if he went through with it. It's probably, he's a deal maker, and it could be a pressure tactic, but it wouldn't be a source of inflation. It'd be a once and for all. Think if the oil price went up, like, doubled overnight, it would be a massive price shock.
Yeah.
And Kamala Harris has all sorts of goodies on subsidies and other things, but the fact she's going to raise top marginal corporate tax rates and capital gains is going to have the opposite impact on risk taking and capital formation and business investment, and lead to a negative hiring cycle. So, here me and you were having this conversation just a few weeks ahead of the election, and it's going to be a pretty big deal because either way, I'm not impressed with either candidate's policies. There's planks that I like, but in totality, no, I am not a big fan of either. So I'm really praying hard that we get the checks and balances from the House and the Senate. All that said, the most important thing I think that I mentioned was that having locked in those rates, which buys you time, buys you time.
Mm-hmm.
does not mean the business cycle has been repealed, but it helps explain why the lags. You're going to have to pay the piper unless the Fed ends up pulling rates down aggressively.
I was going to say it depends on how quickly interest rates, quote unquote, ride to the rescue here. From your best guess right now, it doesn't sound like you think it will from your tone I'm taking.
I think that, Powell told us a few things. He said that, this is going to be a process. It's not one and done. He's not in a big hurry.
Okay. And sorry to interrupt, but you don't think the blowout jobs numbers have to slow his roll a bit?
Well, do you really think blowout? Well, I don't know. Where does that come from? 350,000 is blowout.
Yeah,
That's
I
blowout.
guess that, yeah.
A
So
point, you're telling me, hold on, a 0.16% increase? If retail sales went up 0.16, would you say, Rosenberg, what a blowout retail sales report? You see, that's the thing, is that I thank my lucky stars. I started my own business that, like, I read the tripe that's out there, and that this was a blowout number. This is a blowout number. Adam,
no,
with all
no,
respect,
you're making a great point, and I should
no,
have picked
no.
my
Do
words
you know
differently.
the number in March, the number that came out in March, that came out in early April, was twice as strong as this. And decline in unemployment, increase in wages. It was a much stronger report, and the work week went up. And the response to the bond market was a third of what we've seen since Friday's blowout.
Oh,
It's the
yeah.
first time I've seen a two handle on a non-farm payroll headline referred to as a blowout, but everybody's calling it a blowout. I'm thinking, maybe I started the industry too early, because I remember what a blowout payroll report really was. But no, what nobody talks about, the thing is that people just report the data. Okay. Thoughtful analysis is in a secular bear market. I cannot believe the stuff people have sent me. Nobody's talked about the fact that the work week was down 0.3%.
Okay. I
Nobody
actually
talked
was going to
about
ask
that
you
the
about that
34,
part.
pardon me?
I was actually going to ask you about that, but
Well,
keep going.
well, because it sort of makes the blowout remark almost comical. But I know that is the widespread consensus narrative. It was a blowout report. Really, really, aggregate hours worked, which is total labor input into the economy, was negative 0.1 month over month. It's been flat over the past 6 months. So companies may be hiring. I don't know where the hiring is coming from when we know that Jolt's hiring is down 10% over the past year. So that's a very interesting phenomenon.
Yeah.
However, hiring more, not firing, but cutting the hours. Okay. But the thing is that when you map out employment against real GDP, it has an historic 80% correlation. When you add in hours worked, the number of hours you actually worked, that correlation expands to 90%.
Mm.
So you have to take a look at a holistic view of the labor market. So total labor market input was negative 0.1. It hasn't grown in 6 months. Productivity is doing all the heavy lifting for the economy. I look at the data on Friday, and I'm wondering what planet. Like, I guess I feel like I'm Christopher Columbus in front of Ferdinand and Isabella, trying to convince them that the world isn't flat. I'm looking at the data, and everybody talks about average hourly earnings up 0.36% to the second decimal place. Of course, average hourly earnings went up because the work week went down.
Right.
Hours are the denominator. Oh, what? We got some sort of magnificent wage boom. Dude, the work week went down. What you want to look at is average weekly earnings. Average weekly earnings were basically flat. And then we're going to get a CPI number this week. Looks like it's going to be plus 0.1. So this blockbuster blowout report generated flat to negative real work-based income. Interesting. I'm looking at manufacturing. Employment negative, flat work week, and factory overtime hours were down 3.3%. What? That tells me we're going to have a negative industrial production number for September. So I'm looking at this so supposedly, allegedly blowout number generated the conditions for a negative real work-based take-home pay and a negative industrial production. But that's a blowout. That's a blowout number. It just absolutely boggles the mind. It
So
boggles the mind. And if we look a little further, by the way, there was so much hair on this report. Okay, the seasonal adjustment factor was the most aggressive for any September going back to 1939. Secondarily, there was a big bump from the government sector, which also showed up in the household survey. The household survey showed something like 785,000 seasonally adjusted government jobs were created in the month of September. So something is going on here with the seasonals between summer and back to school. And you saw that in the ADP number as well with health and education. So something was definitely happening there. I'm going to be fascinated to see what the October data look like. But no, I don't subscribe to the view this was a blowout number. I don't think this is the number that's going to define the Fed. Even before the number came out, Powell said we're going 25 and 25. I don't think this is going to sway them. But I will say that when people do the analysis, which they don't, there was quite a bit of hair on that number. Besides the fact that, you bring up payrolls with a 40% response rate,
right.
but you don't bring up ADP, which has a 100% response rate, which is what, more than 100,000 lower than the establishment survey. And you look at the conference board survey, again, the survey data that the Fed was telling us, we're watching survey data. If the labor market was truly blockbuster blowout, don't you think Kamala Harris would be leading Trump on the economy?
You'd think so. Let me just interrupt because I want to keep drilling in here, and just to regular viewers of this channel know, maybe you don't know quite as much. I'm first in line to cast suspicion on the jobs numbers, which is one of the reasons why I asked this question. Just the term blowout, which first I want to say it's great we have people like you, David, who have had a tenure long enough to have the perspective of what truly is good on an absolute level and what truly is bad. I think we've been in such a deformed environment for so long that our sense of our compass points are warped here. So it's great to have the long-term benefit of your wisdom. I think in terms of blowout, what I meant was, and I have used that term, I heard that term used like you have, was that I think it was like a 4 sigma beat relative to what expectations were. So it was sort of a blowout relative to what the street consensus was. I totally agree with everything else that you said. And where I want to go with this is, the high level question I want to ask you is the Fed sort of navigating by faulty data here, right? Is it taking too much of this data into account and thinking the employment market is better than it really truly is? And you noted a couple of important things like supply increasing at a much faster rate than demand. You talked about productivity. I know from some of your recent work, I believe, correct me if I'm wrong, but that you look at what's happened over the past couple of years, and companies were really over-incented to invest in automation, technology, productivity. And so, as you said, productivity has been going up. That's been part of the success story here. That's coming at the cost, though, of labor demand, and maybe even much more in the future as they continue to do this. Their demand for labor in the future might be secularly going down. And then lastly, as quote unquote good as the job numbers might be, it looks like a tremendous part of them is coming from the government. And so is the government like really putting its thumb heavily on the scale right now, which especially maybe in election year, you might expect them to, but it seems like a lot of the headline data is being dramatically overweighted by what's happening on the government side.
Right. Well, 3/4 of that payroll number was in government, health, education, and leisure hospitality, which is a real head scratcher because you didn't have nearly those same number of jobs in the ADP for leisure hospitality. And if anything, what you saw out of the base book is that spending in this once hot cyclical sector is cooling off. Like I said, it would be one thing if the reason why you said the Four Sigma event. Okay, let's assume that that's true. I'm not so sure, but let's say it's true. Uh, well, why wasn't the consensus looking for a number like that? Why was this above the highest estimate? Because it really is very difficult to believe. We have so many other inputs. I mentioned the ISM employment surveys. We're actually contractionary,
Hmm.
both. The conference board's labor market components were the worst since the winter and spring of 2021. The Challenger numbers, the Intuit numbers showed that small business employment was down almost 5,000, which was corroborated by the ADP. Now, the ADP has a 100% response rate. It wasn't anywhere close. I don't think anybody thought that the ADP was a blowout. It came in line with consensus. The odd man out here is the beloved non-farm payrolls.
Right.
The problem for the Fed is that, and maybe they'll have to get away from that, is that they've elevated non-farm payrolls as the holy grail. The response rate's down to 40% post-COVID. A lot of that is because it's taking small businesses longer to get their responses in. So there's so many guesstimates that go in. So we'll see what this blowout looks like 3 months from now. I said before that the numbers have been revised to the downside 75% of the time in the past 12 months.
Right.
That
And
tells you
certainly, Jeff,
something.
but
So
when we,
anybody who's trading off the monthly non-farm payroll report, and anybody who is basing their future decisions on the non-farm payroll report, deserve to be taken out to the woodshed and whipped. This number is going to get revised. Maybe you think it'll get revised up. I don't know how, based on every other labor market component in September, was not corroborated by the non-farm payroll report. However, it is a whole report. And I haven't seen one person talk about the most important correlation with GDP, which is the index of aggregate hours worked.
worked.
Nobody
Yeah.
talks about the fact that it was, if this number was coupled with an increase in the work week, I'd be thinking, whoa, Nelly, okay, I got to go back to the drawing board. The work week was negative, and the work week, by the way, is the only component of the employment data that make its way into the index of leading economic indicators. 34.2 hours is tied for the lowest level since April 2020 and exactly where we were before the 3 prior recessions. So no, I'm not throwing in the towel. I've got people will call me stubborn. However, I just like to call it resolve. And it is true, rolling recessions, not been rolling recession. Housing has been in a recession for a long time. Manufacturing's been in a recession for a long time. It's not rolling anything. It's just that you've had the consumer, which is the dominant force in GDP, continuing to outperform expectations. That's really what the story's been.
Can I ask you about that then, which is, I believe you agree with this, but tell me if not, that yes, consumer spending is held up. Maybe it's been more resilient than many people expected, but it is a K-shaped consumer economy, right? Where there is a smaller amount of more wealthy people doing an awful lot of spending, where, below the line, let's say it's the bottom 80%, are increasingly struggling here. And so, a big question is can that top 20% keep carrying things, or do they get to a point where they start to slow down and then everything, gravity really begins to kick in? And I want to note too that you said that first we gave people a bunch of money, right, during COVID, so they had excess savings. They spent that down, and that was the first stimulus to the economy. Then they dropped their savings rate, which is basically a second stimulus to the economy, right? Rather than save that money, they were going out and spending it. We haven't
100%.
talked about this too much yet, but then we've seen, credit balances skyrocket again post-pandemic. And so not only are people saving less, but they're putting an increasing amount of their spending on the plastic, right? And that apparently has some sort of expiry date at some point, right? You can't do that forever, right? So do you see these as kind of, the consumer kind of selectively, incrementally exhausting all of its options, and then we get to some point where there are no more ways to keep the funds flowing, and then consumer spending starts drying up. And as you said, we're a 70% consumer GDP economy. Then we start actually seeing that shoe drop.
Yeah. Well, look, the low end of the income spectrum has really been under strain for the better part of the past year. Their excess savings ran out. They're living paycheck to paycheck. And you're right about the K-shaped economy, but we're dealing with aggregate numbers. So we get those consumer spending numbers every month and every quarter. They include everybody. And so the upper middle class and the upper class, they're holding the glue together. Now, so what's been happening? And you mentioned the savings rate going down. Why is the savings rate going down? Because the stock market has only been going up. It doesn't matter that earnings, we're going to get third quarter earnings up 5 to 6%. And the stock market's up 33%. And people think this is a normal market, that we have prices. It's not an earnings driven market, it's a multiple. The degree of confidence is incredible. Now, we have the situation where over half of the market capitalization is in these passive index investing funds.
Yep.
People are buying stocks. They don't even know what they're buying. They're buying the index. The index is populated with argue with the best companies in the world. Doesn't make them the best stocks in the world, but you have people invested in the stock market today to a degree who don't have a clue as to what they're doing more than any other time in my 40 years in the business. You don't have to do homework, don't have to do any analysis, just buy the low cost index. Now, what has me really concerned is not only that we had a very highly concentrated stock market, but we have a very concentrated household balance sheet. 70% of household financial assets are in equities. That's unprecedented. That's higher than it was during the dot-coms. People say, well, it's not the same as the late 1990s. And I'm not going to say it's the same, but we don't have, these companies are cash flow rich. They're real business models. But what I'm saying is that what has me most unnerved, and what I think will surprise a lot of people, because nothing moves straight up forever. As Herbstein famously said, anything that can last forever will not. By definition, therefore, this bull market in equities will not last forever. But when it morphs into a bear market, and it will, nobody can time it, the valuations are extreme, and maybe it'll come from the simple fact, like we saw, in today's action, that you get bond yields backing up for a while, and then all of a sudden the stock market screams uncle. If you go back to that period in 2022, it was the bond market that led the stock market. And one of the few times we had a real serious, almost year-long correction of well over 20% without there actually being a recession. The bond market can sometimes give the stock market a pretty big spanking. And it means I'll have to wait for my bond call to come to fruition, but I'll have time and I'll have patience on that call. However, there's more at stake right now. There's more at stake. If we go to a bear market in equities, the reversal, the movie being rewound is going to be so painful. I cannot believe 70% of the household sector financial balance sheet is in equities. Do you know that only 8% are in bonds? That's it. And even among the boomers, the aging but not aged boomers, the pig and the python, 78 million people. I mean, they're heading into what? Their 70s. 60% of their asset mix is in equities. It should be half that.
Right.
So everybody is all in. And nobody has rebalanced. Nobody has diversified. And when this turns into a bear market, if you believe in cycle theory, the impact this is going to have on the economy by a reversal in the savings rate. If you can only imagine what a normalization of the savings rate would do, a 5 percentage point increase in the savings rate from where we are today would give you a very significant consumer recession. And I think that's something nobody talks about. I've been talking about it. And the fact that it hasn't happened yet makes people tune you out or whatever. That's fine. I've been here before. But you see, everything, Adam, is riding on the stock market. And if this thing rolls over, looking at the composition of the household balance sheet, especially the boomers, the experience of not being prepared and not being diversified is going to be very painful. And you will be seeing consumer spending on cyclical. Okay, people will still be spending on rent. They'll be spending on food, but it'll be the groceries, not the restaurants. We're seeing that already. They'll be paying their utilities, but everything else is going to undergo a spending recession. And people talk about the consumer 70% of GDP, but remember that half of that 70% never goes down in a recession, right?
Right.
You still have to live in your home, heat your home, you still have to eat.
You still have to eat, yeah.
And you still have to pay your medical bills. So really half of that 70% is
Will
what
continue.
matters.
Yeah.
And that's what is going to be most at risk.
Okay, so let's get to the so what part of this, David. So looking through your lens, right? I don't get the sense you think that we're seeing data that says the wheels are going to come off this thing like tomorrow and everybody jump in the bunker now. But how do you think about allocating capital today, given that things are continuing to work, but you have this concern that these important shoes have a high likelihood of dropping some point over the next, 12 months-ish?
I would say that 12 months gives me enough breathing room. I don't know what other rabbit's going to be pulled out of the hat.
And obviously, whoever wins the election will have some influence
I
on this
know,
too.
and
Yeah.
then people, but it's not like the Harris plan is going to give a lot of goodies and subsidies out. However, increasing top marginal rates on the business sector when the business sector does most of the hiring in the economy, not something I would advise. Donald Trump, I don't know the extent to which his tariff threats are just a threat, but not something I would advise. So fiscal policy right now is really up in the air. Let's assume that we'll have split government, which means a lot of the things that they campaigned on aren't going to see the light of day, and that wouldn't be a horrible thing. I think that, yes, I think that the expansion has been living on borrowed time. It's lasted longer than I thought, but I still think it's on borrowed time. And I think you put it very well that there's no imminent collapse. And actually, I'm not even calling for a collapse. It's just basically understanding the nature of the business cycle that coincides with the market cycle, the rate cycle. That's basically it. The lags were longer this time for the reasons that we discussed. But the recession has been delayed, but I don't think it's been derailed. And I think that in addition to everything we've talked about, the fact that households and companies locked in their rates really slowed the impact of what the Fed had done. This is why the recession started earlier in the early 80s under Volcker with a similar tightening in policy this time around. But like I said, it buys you time. But like my grandmother always said to me, forewarned is forearmed. So we just have to know that it's out there. I don't people that say no landing, soft landing, which is where we've been, that will be perpetuated, is to say to you the business cycle has been repealed. that interest rates don't matter in the most credit and interest sensitive economy that we've had in our hands in many generations. It just doesn't make sense. We've had fiscal stimulus. That's really in the rearview mirror. We had the savings drawdown in the rearview mirror. And I don't know, and I would say that if the stock market continues to rip and rip and rip, and the clown of the circus is just continuing to blow up this valuation balloon, then who knows? Maybe the savings rate goes down to 1% or 2% or zero. Maybe Americans will feel so confident that they don't feel they have to spend a penny. And if we go from a 5% savings rate, and don't forget, we've gone from about 10 before COVID to 5. And people will say, well, why not go to zero?
Right. Nothing bad
Okay,
happened yet.
if that's the way you want to run the economy, I just won't save anything. And that's one of the biggest surprises because something like half of the American households going into COVID didn't have enough savings to get through 3 months of idle economic activity, which is why
Hmm.
the government had to step up to the plate. And I thought that memory would be seared on people, but I underestimated how narcissistic society has really become.
Hmm.
But maybe if the savings are, you're going to say, what's your biggest risk to your forecast? Is that the savings rate having gone from 10 to 5 goes from 5 to 0, and the consumer will just continue to chug along. But I would posit that that is going to take an ongoing positive wealth effect from the stock market. So I don't know, multiple, is it 21, 22 forward? Will it go to 24? Will it go to 28? Will it go to 30? I mean, this is the sort of stuff that we're talking about. But the main point I'm making here, Adam, is that everything from here going forward on the economy rests with the stock market. We talked about recessions. I'm looking at the economy from a bottom up standpoint. I'm looking at capitals. There, despite the AI boom, there's no capex cycle. I'm looking at core capex orders and shipments are negative year on year. Commercial construction. The housing market is in various levels of disarray, and certainly this backup in mortgage rates aren't going to help. The export sector is going to be damaged by the fact they have weakness. And look, what China did is not going to save its economy. They've just provided tremendous liquidity to bolster the stock market and animal spirits. Now, maybe they'll come through with some blockbuster fiscal package. So far, the market is only reacting to that prospect, but China's economy is really weak. They're in a secular growth turndown. Where is the growth around the world? Even India is slowing down. UK, tiny, tiny, tiny growth. Germany's heading in recession. So no export multiplier. Capital spending is flat to negative. It's incredible. The AI boom. Now maybe maybe the AI part just isn't big enough, but capital spending, housing, manufacturing, exports. So you're left with government. But you see, if we get gridlock, that story's over.
That story's over. Yeah.
And everything going forward on the consumer is going to rest on what the savings rate does from here. Because even though the unemployment rate came down last month, it is on a rising trend, and with a lag, that's going to put downward pressure on nominal wages. So everything really rests on the stock market. And if it goes in the other direction, see, that to me is the principal risk. The principal risk is what happens if we get a bear market in equities. And when I say there's more writing on this than ever before, in terms of the impact on the consumer, is because of the unprecedented extreme concentration of equities on household balance sheets.
Yeah.
That's
And so that
that is actually my biggest concern.
So the stock market driven wealth effect, we have the tail truly wagging the dog here. And if that reverses, you're saying, the economy and the system has never been this dependent upon the stock market before.
You get a bear market in equities, you're going to have 75 and 80-year-old baby boomers lining up to work at Walmart as a cashier.
Right, because as you said, their retirements are more long equities than they've ever been. Yeah.
People over the age of 65, like really 60% equity exposure, really.
Right.
But then they'll say, that's what my financial advisor told me to do. So this is what happens in a momentum and multiple driven market. And the complacency is just absolutely startling. And
Okay,
the view that the
good.
business cycle has been repealed is equally startling.
Okay, so just to get to brass tacks here, and I'm also noticing we're coming up in the hour, so I want to be respectful of your time. Let me make some intuitions, and then you can correct me here. Here's what I think you would say in terms of allocating capital. To the extent that you are in equities, first off, make sure that your exposure to them is appropriate for your age and your life situation, right? That don't be at 70% equities if you're 70. Um, Sounds like you would say in equities, think about diversifying in general, but certainly diversifying more into emerging markets than perhaps has been the case up until now, because a lot of these markets are starting to outperform, and there were several you mentioned you liked: Hong Kong, UK, Canada, emerging Asia being your favorite one. Sounds like you would say if you're nervous, and it probably just wouldn't be a bad thing anyways to have some part of your money parked in dry powder, safe in short-term T-bills. Sounds like you're also pretty bullish on long-term bonds over the next 12 months. Yeah, yields could go higher here in the short term, but you think directionally interest rates are going to come down further, and that's going to benefit long-term bonds. Because of declining interest rates, I think you would be pretty favorable with the precious metals and
Yep.
probably commodities in general. How am I doing so far? Am I ticking off the right things?
Well, I like the precious metals. I mean, the look, oil obviously, and I've written about this, is always a great hedge in sort of troubled geopolitical times that we're in. To me, that's more of a trade. I think that I like the precious metals. I don't like cyclically sensitive commodities, which were doing very poorly up until the China stimulus package, and then the breakout of the hostilities between Israel and Iran. But even within the S&P 500, aerospace defense that has visibility. And military budgets are going up around the world for obvious
Mhm.
reasons. They have visibility, uh, and have been a good place to be. So there's parts of the stock market I like. Utilities. We were fans of utilities for the past 5 years, and
Yeah,
not and
you've
of
done
course
great
because
recently. Yeah,
because they're bonds and drag,
yeah.
like the rate sensitivity, the defensive characteristics, but they've been re-rated for defensive growth because they're part and parcel of this AI driven
AI.
power boom that they'll benefit from. So utilities plus dividend yield, dividend payout ratios. So there's some sectors of the stock market. I like the rate sensitives. You could argue that telecoms would be part of that.
Okay.
If you're going to be invested, I mean, consumer staples, I have no problem with that. There's parts of the stock market that I like and wide swaths that I would rather avoid. I would not be buying the overall index. And in terms of the global exposure, yeah, look, if the U.S. stock market goes down, everything else will go down. I just don't think it'll necessarily go down by as much. I mean, the U.S. market trades at a 21, 22 forward multiple. The UK, the FTSE 100 is like a 12 multiple. Uh, um, the Hang Seng is a 10 multiple. I love the fact that in Japan, and that's been a long-term play for us, and it had nothing to do with what the currency was doing. It had to do a lot with idle cash on corporate balance sheets being put to work, and this last leg of Abenomics that has been taking place, I don't think is going to be going away. But when I see that 38% of the topics is trading below book value, well, hello.
Yeah.
So it looks like the BOJ is not going to be doing anything. They might be getting some fiscal stimulus in Japan. So that's an area I like as well. So I know people think I'm some sort of radical perma bear because I'm not doing all the tree hugging with the S&P 500. But there's other parts of the global stock market that I actually am comfortable with. But everything you said, bonds and bullion, the bond bullion barbell. I've been there and I'm staying there. I love
All
that trade.
right. And yeah, you gave us lots of, beyond commodities and precious metals and bonds, you gave us a lot of stock sectors to look at too. So yeah, I don't think you're a bear, my friend. I just think that you play the cards as you see them. All right. Well, you're nodding as I'm saying this. David,
Well,
it's been a
I'm
fantastic
holding.
discussion.
I'm holding a full house, just to let you know.
Okay, great. Well, David, look, first off, I'd like to just, you always, I hope you know, you always have an open invite to come on the channel anytime you like. But certainly you want to extend the invitation to come on relatively soon after the election, just so you can kind of call an audible saying, okay, now that I know who won, here's, the knock-on effects of what I think might happen to my overall outlook. But in between now and then, for folks that would like to follow you in your work, where should they go?
You can just Google Rosenberg Research, and it'll take you right to the website, or rosenbergresearch.com. If you want to get in touch with us, information at rosenbergresearch.com will take you right through to my business development team, and they'll get you signed up right away for a free trial. So you can either information at rosenbergresearch.com or just go straight to the website, and it'll be pretty obvious how you can kick my tires.
All right. Well, fantastic. Well, David, look, when I edit this, I will put up the links, the URLs to both your website and that email address so folks know exactly where to go. Folks, there'll be links in the description below this video as well, so you can get there with one click if you want to. And folks, if you'd like to express your thanks to David for coming on and being so generous and sharing so much of both his vision, but also his allocation with us, and would really like to encourage him to come back on soon after the election, please do that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And folks, David gave us a lot to chew on here. If you're thinking about the type of road ahead that he's laid out for us here and would like some help in figuring out how to position your portfolio from it, highly recommend that you work with a good professional financial advisor in doing that. If you don't have a good one, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. As a reminder, these consultations are free. There's no commitment to work with these firms. It's just a free public service that they offer. Also, a reminder that we are now just a little bit over a week ahead of Thoughtful Money's fall online conference. So you have just a little bit over a week to buy your ticket if you haven't bought it yet. If you haven't bought it yet, run right now. Don't walk, run to thoughtfulmoney.com/conference. Get your ticket, because if you get it before midnight this Sunday, you'll lock in our last chance to save price until the tickets rise to their full ticket price. A reminder as well, if you can't watch live on the actual day of the event, which is Saturday, October 19th, don't worry. Everybody who buys their ticket is going to be sent a replay video of the entire event, all the presentations, all the live Q&A. So if you can't watch live or you can't watch the full day live, you can watch to your heart's content with those replay videos. And a reminder too, everybody who is a premium subscriber to our Substack also gets an additional $50 off of the price of the conference, whatever the ticket price is when you go to buy your tickets. All right, and for that, David, I can't thank you enough. It's always so wonderful when you're here on the channel. Any last parting bits of advice for the regular viewers watching this channel who are hoping not to become collateral damage to some of the reckonings that you see potentially lying ahead in the future?
Well, all I'll say is make sure that you're diversified and you have anchors and ballasts in the portfolio that will help mitigate the damage if we go into a bear market. So when you're trading at these multiple levels, it's nice, but it means that the risks are also going up measurably. So just make sure that you have some decent diversification in the portfolio, which, by the way, most people don't have. But you can
All
be the
right.
first.
Very well said, my friend. All right, everybody watching, please take that to heart, and thanks so much for watching.